Yes, you can.
Okay. Good evening, everyone. On behalf of the organizer and founder of CASA, CA Sumit Garg ji, I extend a very warm welcome to all participants who have joined us today for this refresher course on corporate law, starting from today and continue for 7 sessions daily. In this session, we will cover NBFC Regulatory Reset 2025, RBI Master Directions, Digital Lending and Scale Based Regulations, an overview, and Company Incorporation in Dubai. This discussion will not only enrich our technical knowledge but also equip us with practical applicability to apply in our professional journey. This will also be followed by an interactive Q&A session. So we encourage all participants to note down their queries and share them in the chat box. Now, I would also like to introduce C.A. Sumitkar ji, founder CASA. He is a fellow member of ICAI with over 18 years of professional experience. He has also served as the Secretary of NIRC of ICAI during his tenure as a regional council member. CASA is an initiative dedicated to the growth and welfare of the CA profession since 2010. Under Sumitji's leadership, CASA has been consistently working towards grooming young chartered accountants and creating platforms for knowledge sharing through regular webinars, seminars by expert faculties, and various other professional development activities. Now, I would like to invite CA Sumit Garg ji to kindly share a few words with us.
Thank you, Priyanka. First of all, I would like to thank to each participant for joining this refresher course where we are going to discuss the various topic in the next 7 days. We also would like to thank our first faculty, Nitish Aggarwal ji, along with other faculties, Bharti Goel ji, and so on. We have designed this series in the 7 sessions where we are going to discuss various different type of topics that will give an idea of the subject and what are the new opportunities in that. Likewise, we can say NBFC regulatory reset. Today we are discussing. Tomorrow we are having business valuations. Day after loan or advances. Because Companies Act definite in Companies Act different provisions are there, but the most important section is there like loans given to directors or whether it will be treated as deposits, which are we have accepted the in form of advances. Thereafter we will discuss SME IPO, किस तरह से हम SME IPOs में काम कर सकते हैं अपने क्लाइंट के लिए, merger acquisitions, thereafter IBC insolvency bankruptcy code, and in the last next seventh session would be on the auditors appointment, removal, resignation of the auditors, along with the compounding of the corporate criminal cases. We would also like to thank our all 8 experts and 7 moderators in this series, and I would like to thanks to each participant who are able to join this series. And you can give your suggestions, if any, on the topic, on any issues later on my number. I have shared to each one my number. So you can give your suggestions. And presentation and recording will be shared daily after the session in due time. So I hope you will all enjoy this great learning series. And if you want to add any other topic apart from this series, कि लगता है कि कोई और टॉपिक है जिस पर डिस्कशन हो सकता है, तो हम सजेस्ट करेंगे. काइंडली सजेस्ट मी सो दैट वी कैन इनकॉर्पोरेट इन अपकमिंग डेज. एंड with this, once again, happy learning to each one of you. Over to you, Priyanka.
Thank you so much, sir, for your kind words and support. Today's first session will be deliberated by our distinguished speaker, CA Nitish Aggarwal ji, and second session by CS Bharti Goel ji. And it is indeed my privilege to introduce him. CA Nitish Aggarwal ji is a partner at DJNK and Company LLP and co-opted member of the Digital Assurance and Accounting Board of ICAR for 23-24. With nearly a decade of professional experience, Nitish Ji specializes in NBFCs, Ind AS, and assurance assignments and has led major engagements across gap audits, ICFR, due diligence, and process transformation. He has international exposure from his work in London and Scotland with global banks and has authorized widely read articles and delivered trainings on Ind AS, IFRS, and data analytics. Please welcome CA Nitish Aggarwal ji.
Thank you, Priyanka ji. Thank you, Sumit ji. Thank you, audience, for being here. Um, Sumit ji, can we directly start with the topic?
Yes, you can.
So let me know when my screen is visible.
Yes.
Sure. So today we are going to be discussing about NBFC and the regulatory reset in NBFCs in 2025. So we'll cover a very high-level brief about the various master directions that are there for NBFCs and also the digital lending directions. The digital lending directions again have been something that have been very recent, although all of the topics or all of the concepts that we are going to cover today have been there for a good decades over here, and there's been a series of evolution that we have witnessed over the last rather 25 or 28 years when since when the RBI started regulating these NBFCs. So what's the significance of this NBFC? So first of all, NBFCs now mirror banks in regulatory expectations. So today, NBFCs are as tightly regulated as our banks. Today, there's a very rapid change in the form of various new regulations that keep coming in, and I think RBI, along with SEBI, is perhaps one of the most dynamic regulator, and also along with being dynamic, it's not really onerous or just burdensome provisions or compliances that they just keep adding. It's also a lot of operational issues that they keep resolving through their various regulatory frameworks. So in order to resolve the ever changing landscape on in the NBFC sector, the RBI keeps bringing these new regulations. For example, the scale-based regulation. Then you've got the digital lending regulation. You've got IT, cybersecurity, outsourcing regulations, etc. There's been an RBI's increased supervisory heat in the recent period, and it's been at least the last 10 years have been where RBI has been pretty stringent about how any of their licensed entities operate. Then you've got NBFCs, which are and this is very meritorious for all the people here, are also one of the highest employers of young CAs in India. You need a bird's eye view and a practical view on this topic, and thus, thanks to Sumit ji and Team GASA, that we'll be versing ourselves with a refresher of NBFCs. So first of all, let's cover NBFC landscape and the master directions. So the NBFC has been defined by the Section 45IF of the RBI Act 1934, and the definition has been laid down in the form of principal business criteria. So what it means is that any company or any private or public limited company, when operating a business which has at least 50% of its balance sheet or total assets as financial assets, and at least 50% of income originating from these financial assets, when both of these conditions together are satisfied, an NBFC is formed. So once an NBFC is formed, or once you're classified as an NBFC, you automatically are required to comply with the regulations of an NBFC. So obviously, on the other hand, this also means that any company which is not an NBFC cannot have more than 50% of its assets as financial assets, and at the same time not have income from financial assets being more than 50% of the total income. So NBFCs are finance companies, and typically how they differentiate between with the banks is that NBFCs cannot accept demand deposits. Bank can accept demand deposits, but NBFCs cannot. NBFCs do not form part of the payment system and settlement system, and cannot issue checks drawn on itself. The deposits with NBFCs are not available under the insurance facility, and will be uninsured deposits under the RBI Act. They're regulated by the Reserve Bank of India. So, having learned about what an NBFC is, let us go about understanding what the typical master directions or the typical regulatory framework around an NBFC is. So, RBI is the principal regulator for an NBFC, and also I'd like to add over here that NBFCs are not just of one type. NBFCs are of various type, and one of them is the normal NBFC loan company, ICCs, etc., information credit companies. You've also got special category of NBFCs, for example, account aggregator. Even housing finance companies are a separate category of finance companies. Then you've got peer-to-peer NBFCs. So there are a lot of NBFCs that are there, and each of them is regulated along with these general regulations by some specific regulation as well. So, for example, for NBFCs peer-to-peers or P2P NBFCs, there is a specific direction called NBFC peer-to-peer regulations or master directions. However, we'll just stick to our focus on the general framework for most of the widely known NBFCs and probably NBFCs which, as professionals, we would be dealing on a daily basis. So the NBFCs can be looked at from three perspective or in under three categories. So one of them is the core master directions. So in 2023, RBI brought in the scale-based regulation directions, which was, I think, around 2 years ago. In 2021, they brought in the scale-based regulation framework, and in 2 years, they compiled everything into scale-based regulation directions. So the framework was introduced 1.5 or 2 years ago, and in 1.5, 2 years, they issued a series of circulars. They issued a series of guidelines, all of which cumulated and culminated to form the scale-based regulations, which today form the major most foundation or the primary foundation of how NBFCs are built, set up, and operate. Apart from that, there are some three of the regulations: NBFC, non-deposit taking, systemically important, and acceptance of public deposit. These are three different directions from 2016, which, although have been revoked after the issuance of scale-based regulations 23, still continue to be applicable on a residuary applicability perspective. So, in fact, from an NBFC, NDNSI or non-systemically important and systemically important direction 2016, almost everything has been withdrawn. With respect to acceptance of public deposit, the applicability still continues to a very small extent. Also, it may be useful for us to know here over here that in India, there are barely under 30 NBFCs which currently hold deposit taking license. And while a couple of them, probably a little over 10 or a little over dozen NBFCs of these deposit taking NBFCs are probably state owned, or for example, I think there's this NBFC called Tamil Nadu Finance State Finance Corporation. So something like that. And these are the kind of NBFCs which hold the public deposit license. And RBI today doesn't issue any new public deposit acceptance license in to NBFCs. And the existing ones are, as I said, a little less than 30. A little over dozen are state finance corporations, and the rest of them are probably the likes of Bajaj Capital. Then you've got, with respect to governance, conduct, and customer protection, while a lot of these provisions are also contained in the scale-based regulations, you've also got certain specific directions. For example, KYC Master Directions 2016. You've got RBI Integrated Ombudsman Scheme Master Directions 2021. And you've got Outsourcing of IT Services Master Direction 2023, and you've got Monitoring of Frauds in NBFCs Master Direction 2016. You've also got exposure, transfer, and structured finance being regulated by three different directions. One of them is the securitization of Standard Assets Master Direction 21, Transfer of Loan Exposures Master Direction 21, and Co-lending Arrangement Directions 2025. The co-lending arrangement directions 2025 is applicable or effective from 1st of June 2026, 1st of Jan 2026. So alongside, you can see over here in one corner, I've also specified the link on which these all these directions can be accessed, and RBI has a very systematic way of arranging them on their website. So you can just follow the link and you can get you can access the directions directly from the website of the RBI. You've got scale-based regulations, which are a revised framework for regulatory framework for NBFCs, which classifies NBFCs into four categories. One of them is top layer, upper layer, middle layer, and the base layer. These regulations, speaking about how the NBFC scale-based regulations came into place, we need to go back to 1998 when it issued the prudential norms, which were followed by a series of changes. And in 2022, finally, it brought in the scale-based regulatory framework. So one of the last major changes was done in 2016. So in 2016, what scale-based regulation 2023 is today was preceded by various these three regulations from 2016. So these scale-based regulations were followed by an announcement, were preceded by an announcement by the RBI in the Statement of Development and Regulatory Policies dated 4 December 2020. And it highlighted that there was a need for regulatory overhaul of the NBFCs, because NBFCs, as we discussed earlier, have been a very dynamic segment, and technology is something that has affected it very much. The way NBFCs lend today has evolved significantly. So the way NBFCs lend, the way NBFCs operate. For example, I think a decade ago, probably it was impossible for us to even imagine that an NBFC without a single branch would exist, or maybe a little more than a decade ago. And today we've got so many NBFCs which are lending purely through technology, purely through their apps or through their website. On account of this topic itself, we'll be going forward and we'll be discussing the digital lending framework as well. So, which speaks about how an NBFC which is lending purely through digital mode or medium should be regulated or should operate either directly or through a third party. So the scale-based framework was eventually introduced in 2022 and from was effective from uh, October 1st, 2022. RBI released various circulars and directions over the next 1 year. These all culminated into October and into the master directions on October 19, 2023. This circular divided, or this direction divided the NBFCs into these four categories. So let's go through each of the category one by one. So the base layer, which is the primary category. Why primary? Because I think close to 80 or 85% of the NBFCs would typically be classified under this category, or maybe even 90% of the NBFCs would be classified under this category. So, what are base layer NBFCs? Base layer NBFCs are, in the ordinary context, any NBFC with a balance sheet size of less than 1,000 crore. Then you've got NBFC, certain special class of NBFCs, for example, peer-to-peer or account aggregator category of NBFCs, which, as per the definition, would always continue to be base layer NBFCs. Then you've got NOFHC, which is non-operating financial holding company. These are typical holding company structures in the case of bank. So there's a bank called ESAF Small Finance Bank. So ESAF Small Finance Bank is held by a holding company which is called ESAF Holdings. So any NOFHC would also permanently reside in the category of base layer regardless of its size or any other feature. Then you've got NBFCs. So this is kind of an exemption that has been granted. And NBFCs with nil public funds and no customer interface. For example, there's the National Infrastructure Investment Fund. NBFCs like these would also permanently be classified under base layer regardless of their size of balance sheet. Now, before we move on to the next one, it's quite logical to understand, but still, I'd say that why we need to understand the categorization of these NBFCs is because based on the categorization of the NBFC, the regulation varies. So, needless to say that the top layer NBFCs would be managed by the RBI the most. The upper layers would follow the suit, but the regulation would be much more relaxed. The middle layers are the one which would be regulated to a very reasonable extent, while base layer NBFCs continue to operate in the most lenient environment in the context of the overall scheme of regulation. Then you've got middle layer NBFCs. So middle layer NBFCs are NBFCs which are deposit taking NBFCs. So regardless of their balance sheet size, any deposit taking NBFC would be classified as Bajaj as middle layer. So for example, NBFC like Bajaj Capital. Now obviously Bajaj Capital has a tendency that it may be classified as upper layer as well. But unless classified by the RBI under upper layer, in upper layer, it would be classified as middle layer. Then you've got NBFCs, non-deposit taking, which have a balance sheet size or a total assets greater than 1,000 crore, would again be classified as middle layer NBFCs. Then you've got standalone, just the way we had certain special category of NBFCs which were permanently classified under base layer. You have also got certain additional category of NBFCs like standalone primary dealers, IDFs, then IFCs, then CICs and HFCs. All of these category of NBFCs would permanently reside in middle layer or maybe reclassified. When we read about it more, we'll learn, but may be classified under the upper layer or top layer based on the criteria of top layer or upper layer. So these special category of NBFCs would never be classified in base layer. Then you've got the upper layer NBFCs. So upper layer NBFCs is not based on any threshold or criteria. The criteria has been defined, but the criteria or the scoring methodology which RBI has defined is used to assess which NBFC should be classified under upper layer in the upper layer, and the name is published on a periodic basis. The list is refreshed on a periodic basis. So the top 10 eligible NBFCs in terms of their asset size shall always reside in the upper layer irrespective of any other factor. So the methodology is defined by the regulator. I think there's a small correction over here. The top 10 NBFCs will not be on the basis of strictly of their asset size, but based on a set of parameters and scoring methodology. So these are named by the RBI by various notifications, and only then would they be classified as upper layer. So no, I think this you can ignore the third line over here. But the limit is set in terms of that only 10 NBFCs would be classified over here in the upper layer, and no more than 10. Then you've got top layer NBFCs. So RBI itself says that top layer NBFC, there would be no NBFC in the top layer per se. So unless RBI identifies that there is an NBFC which has a very high risk in terms of how it may affect the economy in case of a failure, if an NBFC is identified, so it will be classified in an exceptional layer called top layer NBFCs. So in normal parlance, the upper, middle, and base layer are the ordinary layers of NBFCs wherein most of the NBFCs would reside. So we'll go by the regulations bit by bit, and the regulations follow a very simple framework. So all of the requirements applicable to a base layer NBFCs are automatically applicable to NBFCs in the middle layer. The NBFC application, the regulatory applications to NBFCs in the middle layer and base layer are again automatically applicable to NBFCs in the middle upper layer. So in the base layer, you've got directions that are applicable to NBFC non-deposit taking, non-systemically important NBFCs will continue to remain applicable. So all of these were applicable prior to the master directions kicked in 2023 or after 2023. Prior to 2023, the framework suggested that the previous requirements will continue, except in regard of certain matters which it covered over the incremental period. So first of all, it increased the NOF requirements. Now NOF in a very broad sense would be more or less your equity capital in a company. Equity and includes reserves and surplus. So in 2020, the default NOF that was required to build and create an NBFC or an NBFC was required to have an NOF of 2 crores. And MFIs were required to have an NOI for 5 crores. The third one is a typo and you can ignore it. In 2025, this has been increased. 31st March 2025, this has been increased to 5 crores and 7 crores. In 2027, this is now required to be increased to 10 crores across all the two categories. So you can ignore the third entry over here being a typo. So this means in 2027, any NBFC would need to have an equity capital of or a paid up capital and some total of the paid up capital and reserves and surplus etc. of at least 10 crores. Else it cannot continue to be an NBFC. Post the scale-based regulation, the RBI changed the NPA norms. So with respect to smaller ones, the NPA and loans were required to be classified as NPA with reference to a aging or a days past due aging of 180 days. In 2024, 31st March 24, this was reduced to 150 days. And today, with effect from 31st March 26, this period would now be reclassified to 90 days. So now any lending institution in India, including NBFC, bank, housing finance company, or any other company, would be classifying an ordinary term loan or a loan or any asset based on a DPD reference of 90 days. The base layer regulation has specified experience of the board, and for the first time ever, RBI required that the board member have on a mandatory basis a member at least who is literate in financial education. So you can't have two engineers on a board of an NBFC running the NBFC unless say they've got a say at least 5 to 7 or 10 years of good banking or NBFC related experience. Otherwise, typically chartered accountants would be very well suited to reside on the board of an NBFC. Then you've got ceiling on IPO funding. So the RBI imposed an IPO funding limit of 1 crore per borrower. Then it imposed a mandatory requirement to create a risk management committee across all category of NBFCs. It enhanced certain disclosure requirements, but still in the case of base layer, it was more of optimization of disclosures, and the disclosure requirements were changed or evolved, and some additional disclosures were required to make. Most of them were in terms of optimization with the existing disclosure requirements in the case of base layer NBFCs. Then for loan to directors, senior officers, and relatives of directors, the RBI introduced a requirement for creating putting in place a policy, a board approved policy for the caption matters. So this is how base layer NBFCs are now being regulated. The middle layer NBFCs, as we discussed earlier, are required to adopt the regulations that are applicable to base layer NBFCs. Along with them, a couple of more requirements. For example, ICAP, which is called the Internal Capital Adequacy Assessment Process, is also required to be implemented in the case of a middle layer NBFC. This is a board level process, and this assesses a bank's risk apart from balance sheet risk. So, for example, risk related to arising from reputational damage, risk arising from matters such as compliance risk, your HR risk. HR risk would include attributes such as a hiring risk or attrition risk. So, a middle layer NBFC is required to put in place the ICAP, an internal capital adequacy assessment process in place. Then earlier, the RBI had separate concentration limits for lending and investments. Now it has converged these limits, and at a group level or at a standalone level, there are various lending and investment concentration limits, and they need to be together seen. Earlier, you could split your lending and investment, and this would lead to a higher possible concentration. But now this has been restricted at a total level as well. Then you've got exposures to capital market, direct and indirect, and commercial real estate, which has been also classified as sensitive sector exposure. So the RBI has asked that the board is required to maintain or implement prescribed internal limits with respect to these particular sectors. Then you've got regulatory restrictions on related party loans and real estate lending. You've also got KMPs to be exclusive. So any KMP in a middle layer NBFC cannot be a KMP in any other middle layer or higher category of NBFC. Similarly, independent directors, while did not have any restriction under the RBI framework, are now required to maintain a capping of 3 NBFCs, which is again a middle layer or higher NBFCs. Chief Compliance Officer, once you become a middle layer NBFC, you're required to appoint a Chief Compliance Officer. You're also required to make certain enhanced disclosures. Obviously, the disclosure requirements with respect to base layer NBFC versus the middle layer NBFC would be extra. Then you've got that there needs to be a board approved compensation policy, and it needs to define at least these 3 principles. One of them is constitution of a remuneration committee, principles for fixed variable pay structures, and malus clawback provisions. So what is malus clawback provisions? Malus clawback is in the case where an employee acts in bad faith, and in that case, what are the provisions or what are the various clawback provisions? Clawback being where any remuneration or any reward paid to him would be subject to repayment, or he would be liable to return those money. Then you've got other governance matters. Board is required to delineate various roles of various committees and lay down a calendar of reviews. The board is required to formulate a whistleblower mechanism for directors and employees. The board is required to ensure good corporate governance practices in subsidiaries. Along with that, a middle layer NBFC is also required to put in place a core banking solution in the case where they've got 10 or more branches. So an NBFC with less than 10 branches need not apply or implement a core banking solution. Then you've got new regulations applicable to an upper layer NBFC. The common equity tier 1 is required to be maintained at least 9% of the total risk weight assets. So for those of you who would understand, it is also called capital adequacy ratio, or CRAR, capital risk weighted asset ratio. So there are two components to CRAR or CAR, and one of them is the tier 1 equity and the other one is tier 2 equity. So the tier 1 equity in the case of upper layer is required to be maintained at 9% of risk weighted assets. This also means that for middle layer and base layer, there is no limit or minimum criteria for RWAs that has been specified. Then you've also got a certain limit on the or ceiling on the leverage that has been imposed. The asset provisioning, the standard asset provisioning is at a higher level as compared to the ordinary or the base layer or middle layer NBFCs. Qualifications of the board members have been prescribed, and the board has, while it has not been very objectively spelled out, it has asked that the board members shall be competent and the qualification and experience should be of a diverse nature. So, for example, you need to have a board with at least one member who has experience or information with respect to knowledge with respect to technology or IT or cybersecurity. Then you've got one which would de facto due to your base layer NBFC applicability, regulation applicability would be required to be financially literate or financially sound. Sorry, sound in terms of handling of finance. Then you've got another one, say, who's well versed in legal parlance, so on and so forth. Then you've got that an NBFC categorized in the upper layer is required to mandatorily list itself within 3 years. Then you've got independent directors, which are you may remove, or an independent director may resign before completion of normal tenure, but subject to permission from the RBI. Then there's a separate exposure called large exposure framework, uh, for which has been introduced for upper layer NBFCs, and the internal exposure limits have also been defined. So, an NBFC in the top layer would have a higher capital charge. A higher capital charge means that when computing their capital risk weighted asset ratio, or CAR, they would be required to weigh their assets at a higher rate than the normal NBFCs, including NBFCs in the upper layer. The requirements shall be specifically communicated by RBI and will be a case-to-case basis. There would be enhanced and intensive supervisory engagement with these NBFCs. So, needless to say that RBI typically engages with all of these NBFCs on from a regulatory perspective, on a case by case basis. In terms of the base layer would typically receive very small or very low attention from the regulator. In terms of the middle layer NBFCs, they would say face an inspection at least either annually, or at least or up to even biannually, but they would be subject to higher regulation. Now, an NBFC in upper layer or top layer would probably have, or rather do probably have, RBI officials seated at their own offices almost on a daily basis for some matter or the other, and conducting routine and very frequent inquiries in terms of one operational matter or the other. So with this, we come to the end of our regulatory framework in terms of various master directions, especially the scale-based master directions. Following this, let us move on to the next framework, which is the digital lending framework. So, with respect to, as we discussed earlier, there are various NBFCs which today are lending only either through, say, with the help of technology or with the help of their virtual presence. For example, you've got Navi Finserv, you've got Lending Card, and so on and so forth. These NBFCs typically only lend through their digital channels, and while they were lending directly through their own own regulated NBFCs, a lot of them also started lending through third parties which were providing this technology. So for example, Navi Finserv lends through Navi Technologies. Similarly, Lending Card uh, Technologies is lending on behalf of Lending Card Finance. Also, apart from NBFCs which are dedicatedly lending through digital platforms, there are also a lot of NBFCs which are lending through uh, mix of these digital platforms or through various, say, physical platforms, either branch models. In order to regulate NBFCs, which were lending through the digital medium, the RBI identified certain concerns and thus proposed that a new framework be introduced. So there was rapid growth and unregulated players stepped in into this segment. So why this happened from a very practical perspective, why this happened was because back then when technology companies were emerging, technology companies demanded a significantly higher premium and were prone to significantly lower regulations in terms of their capital as well. So an NBFC, while would go for an equity round at say an X price, uh, their technology arm, if a separate entity could get as high valuation as say 10x of what the NBFC would themselves be getting for the same kind of business. Thus, a lot of these NBFCs either set up their own technology arms or started working with other technology players. So, consumer protection gaps were identified by RBI. RBI also identified data privacy concerns and transparency issues in terms of inconsistent loan disclosures and lack of clarity on loan terms and conditions. Looking at all this, RBI in 2020 introduced or regulated these NBFCs, digital lending by NBFCs through a slight modification in their Fair Practice Code or introducing a new Fair Practice Code. In 2022, a new working group report, a report by a working group on digital lending was put in place by this working group was again commissioned by the RBI. Later in September 2022, there were guidelines on digital lending, and this was perhaps the first time that RBI regulated the sector completely, or the segment of the sector completely. In February 23, RBI issued certain FAQs, which were followed by a new set of a new set of guidelines on default loss guarantee in digital lending arrangements. So, what's a default loss guarantee? A default loss guarantee is when the technology player started offering a guarantee for the loans that it originated for the NBFC. Now, this was the primary reason why also RBI put in place the requirements of a digital lending guidelines, because in 2023 or rather earlier in 2022 or 2020, RBI identified that non-NBFC companies which were not licensed by RBI were using NBFC companies through various contractual arrangements to lend money and were carrying the risk themselves and were managing the operations themselves. So RBI got the wind of it, and RBI noted that there are certain unregulated players which are acting or which are active in the lending business. This led to all of the digital lending framework over time, and in 2023, even the default loss guarantee part was covered by RBI through a separate guidelines. In 2025, the RBI introduced new set of digital lending directions and over consolidated the entire schema so far into a single set of directions called the RBI Digital Lending Directions 2025. This contained the consolidated provisions of guidelines of digital lending as well as guidelines on default loss guarantee. The new digital lending guidelines had various facets, or rather, touch based on various facets of how regulated entities and these non-regulated entities, which are also called lending service providers or LSPs, operate with each other. The first pillar was risk management and loss sharing. We'll cover a bit about all of these facets a little in detail, a little ahead. So RBI dictated how the risk management and loss sharing would be done between non-regulated and regulated players. Then how compliance and customer protection must be ensured. The reporting and governance was streamlined or was rather enhanced by virtue of this new regulation. The board and compliance oversight was also defined by the new digital lending guidelines. Certain new disclosure and transparency requirements were put in place. Technology and data governance standards were specified and how technology and data governance should be ensured. Operational readiness requirements were put in place, and a new requirement for a DLA registry or the Digital Lenders Association, Digital Lender Lending Apps registry was also set up. So the various aspects which RBI touch based upon was by virtue of this regulation, which was in May 2025 consolidated. First of all was LSP onboarding and monitoring. The RBI defined the requirements to put in place clear contracts which needed to define the role of a regulated entity and the non-regulated entity, or alias being the lending service provider LSP. Then it put in place enhanced due diligence requirement. So an RE being regulated entity or the NBFC, when the regulated NBFC engages with a non-regulated entity, it had to ensure by through a due diligence to that they were technologically capable, were sound in terms of data privacy, conduct, and financial strength. They have the financial strength to deliver in terms of their default loss guarantee arrangements. The LSPs or lending service providers were also required to act as service agent, could also act as service agents or recovery agents. However, even when you're engaging as an NBFC, when you're engaging these LSPs as recovery agents, they would still be needed to follow the FPC and conduct norms. FPC is Fair Practice Code. Now, mind you, the important aspect over here that RBI also emphasized was that the important aspect over here that we've seen is that since RBI does not have jurisdiction over non-regulated entities, it imposed all the requirements on the RE itself. So the RE was required to maintain or ensure that there are clear rules, clear contracts defining rules. RE needs to conduct a due diligence. RE needs to, when engaging them as recovery agents, ensure that they are following the FPCM conduct norms. The RE again is supposed to monitor on a periodic basis contracts, portfolio, and transactions. The LSP cannot receive any funds except in case of delinquent cash collections when it visits on behalf of the RE for collecting cash directly from the customer. However, even in this case, there has been a very stringent requirement, and RBI has imposed a requirement to ensure that cash collections that are even made by the non-RE or LSPs are also required to be deposited and reflected in the statement of account of the customer within the same day. Another set of or another category of principles which RBI defined was in terms of disclosures and customer data. In terms of disclosures and transparency, RBI asked for clear contracts defining roles of RE and LSP. Again, something similar that we covered before. When you're sourcing leads or when you're lending through a digital channel, your website or your application is now required to show all matching offers. So a lot of the time, these NBFCs, a lot of these NBFCs operate with a single technology or LSP player. Now, when you've got a lending service provider who's got 10 different NBFCs behind it, so when it is lending to a particular borrower, the application of a borrower may be mapped to one NBFC, but it is possible that the same borrower may also be eligible to borrow from another NBFC with the same part, with the which is partner with the same LSP. In that case, the LSP is required to disclose all the matching loan offers on the face of it before a customer opts for or a borrower opts for any particular loan from any particular NBFC. The REs are again required to ensure that they comply with KFS or key fact statement requirements, penal charges, and cooling off guidelines. So, cooling off means in the case of digitally sourced loans, a digital player on behalf of the NBFC is required to give a cooling period during which the borrower can close its loan without any additional charges, which is typically required to be 7 days for a for any loan, and at least 1 day for a loan which is shorter than 7 days. Then the UI or UX must follow CCPA dark pattern guidelines. So CCPA is consumer protection. So, in the case of consumer protection, there are separate dark pattern guidelines. This is a separate guideline that has been put in place by the CCPA. This is independent of RBI, but RBI has asked that any of these REs which are engaging with LSPs are required to ensure that LSPs must comply with the UI UX guidelines or the user interface exchange guidelines of the CCPA. This ensures that you cannot deceive a particular customer or a particular borrower into borrowing on false premises. You're required to deliver digitally signed loan documents. So the RE would be required to ensure that the LSP is on behalf of them digitally delivering these loan documents. The RE is required to disclose on its website LSPs, list of LSPs, digital lending apps, grievance channels, and names of any recovery agents. Again, with respect to customer data, the REs can allow the LSPs to only collect need-based data and no device access should be given. So a lot of time these loan companies, Chinese loan companies or other loan companies have take the access of your mobile phone and deep dive into all your private data. So that was restricted by RBI to ensure that only need-based data is collected and no device access is obtained, except in case of where specific requirements exist. Then you've got explicit and revocable consent. Even if with respect to data or device access, you've got any permission or consent that you've obtained, the customer should have an option to explicitly revoke any consent. Then you've got LSPs cannot store any personal identification information except basic information, which can help them map all of the loans that they've dispersed to the customer for any particular NBFC. Then they are also required to ensure that data is localized or data localization, meaning that their data is stored in India on a server located in India. Then you've got the last set of framework for digital lending is that in terms of technology, RBI requires that they follow the cyber or technology standards circulated by the RBI. So there are various master directions and various parts in the skill-based master directions where RBI specified the various cyber or technology standards or requirements. Then you've got governance. So the board is required to designate an officer to certify the website grievance and data compliance of the LSP. The uh, the RBI has also imposed a condition for or a requirement for the REs or the NBFCs to report any new LSP or the any new or closure of any LSP or DLA arrangements on the SIMS portal. CIMSS, the SIMS portal or the portal on which all the returns etc. are filed by various NBFCs. Then you've got digital lending or FLDG. FLDG under the default loss guarantee arrangements. So RBI has asked that default loss guarantee arrangements should not be a credit substitute. Credit substitute meaning, so while FLDG can act as a performance measure to ensure that the leads that are being generated by any digital lender are authentic and are of a quality nature, the RBI has asked that RBI has asked to ensure that this should not become a credit substitute. Credit substitute meaning that the losses of customer are being increased, or you're lending to a very risky customer because you've got a credit substitute available. So in short, in other words, you can say that RBI has asked that you should not get into the habit of lending to bad customers just because you've got a default loss guarantee arrangement backing your particular loan. Then you've got BG or bank guarantee, lien in the form of FD or cash collateral being specified as the only medium of default loss guarantee arrangements, and together it has been capped at a total of 5%. The REs or the NBFCs are required to ensure various income recognition and asset classification compliance and CRAR compliance and tenure compliance under the digital lending guideline framework or other framework of the RBI.
So, shall we quickly take up the question, sir?
Sure.
So, the first question is, can NBFC accept loan from other private company?
Um, yes, you can, and it will be an intercorporate deposit. So the way two private limited or two companies can exchange, they can also accept, but it will not be a deposit. It will be an intercorporate deposit.
Okay. So, the second question is, what if the NOA falls from the limit? Does the company does not falls under NBFC? Then do they need to do all the compliances required to be done by private limited once they fail to complete the NOF limit? And what is the meaning of risk management committee? Is it mandatory?
So the first part being with respect to NOF. So once the principal business criteria is achieved, once you've got 50% of your total assets and 50% of your income arising from financial assets, once these two conditions are achieved, you would be required to apply to the RBI for a license of an NBFC, even if you have got a paid up capital of 1 lakh, and even then you've exceeded these limits. You would still be required to go to the RBI to obtain an NBFC license. Else, you would be operating as an NBFC in violation of the various terms of the or various regulations of the RBI. Second part, can you please repeat the second part?
Yeah, sure, sir. What is the meaning of risk management
So
committee? Is it
risk
mandatory?
management committee is a risk management committee is a committee of the board, and just the way you've got audit committee, nomination remuneration committee, RMC has also been specified as a committee which should be required to be maintained. Now, RMC's main purpose is typically to monitor portfolio or various operational aspects of the NBFC. and would typically comprise of various HODs and certain executive members, KMPs or board members. For example, credit head, you've got the IT head, and risk management, as the name suggests, would be in order to ensure, in order to manage risk of the company on a more frequent basis than on a less frequent basis, as in the case of a board.
So the participants are asking for your contact number, which you have already shared with them. So they might be, asking for
I
the
can flash it
questions.
on the screen again.
Yeah, that would be helpful, sir. So I believe, sir, no more questions for today. Thank you so much, sir. On behalf of CASA and all the participants, I would like to thank you for sharing your deep knowledge on NBFCs with us. Thank you so much, Nitish, sir.
Thank you. Thank you.
Nitish ji, thank you very much, and please share your presentation so that we can share with the participant.
Sure, sir.
Once again, thank you for your
Thank you so much.
coverage of wonderful topic on this. One more query: which accounting is software and accounting software applicable to NBFC
So it's
HTDS?
the same. It's the same one.
Okay.
Yeah. Thank you so much. Ji.
Thank you,
Thank you,
Nitish.
everyone.
Over to you, Priyanka.
Okay, so moving on to our second session, I would like to welcome CS Bharti Goel ji, an experienced company secretary and the founder of Goel Bharti and Associates. With more than 7 years of specialized expertise in company law and corporate legal matters, her firm is known for providing comprehensive corporate compliance and advisory services to her clients. Over to you, ma'am.
Bharti,
Thank you,
are you
ma'am.
there?
Thank you. Thank you, ma'am.
Oh, okay. Over to
I'm
you.
here. Can we start this process?
Yes, madam.
Okay. Okay. Thank you, Sumit. Just a second. Have you seen? Is that my PPT is showing on the
We
screen?
can
Please
see
confirm.
your screen.
Okay. Okay. Thank you, ma'am. Thank you. I'm just confirming that. Today's my topic is how to incorporate a company in Dubai. Whenever we talk about the
भारती,
incorporation
ये
of company,
पीपीटी आपकी शो नहीं हो रही है। ये आपने फोल्डर शो हो रहा है, पीपीटी आप एक बार दोबारा ओपन कीजिए।
uh, this one is not showing.
नो, फोल्डर इज शोइंग ओनली which is having three PPTs,
Hmm.
three files. आप एक बार बंद करके दोबारा कीजिए, इसे क्लोज करके।
Mhm.
स्टॉप
Is
शेयरिंग
that showing?
करके। नो, स्टॉप शेयरिंग कीजिए पहले, एक बार मैं स्टॉप शेयरिंग
Okay.
कर।
Okay.
यस,
Okay.
अब
Okay.
अब
Okay.
अगेन कीजिए आप पीपीटी शो शेयर।
Is that?
यस, ये लेफ्ट साइड, हाँ राइट नाउ, ओके।
Is that showing now?
यस, ओके, ऑल ओके।
So now today's my topic is how to incorporate a company in Dubai. Whenever we talk about the incorporation a company in Dubai, so we have to confirm regarding jurisdiction. Where in India, first we have to take the name and object of the company. Whenever we talk about incorporation a company in Dubai, so we have to confirm about the jurisdiction. So how to decide what is the jurisdiction in Dubai when we have to incorporate a company in Dubai? So if we discuss regarding jurisdiction, so there is three jurisdiction. First of all, jurisdiction, it's mainland. In mainland, the department and authority is Dubai Department of Economy and Tourism. This is the authority in mainland. Actually, in Dubai, there is a three jurisdiction: mainland, freehold, freeland, and offshore. Now we talking about mainland. So this is the department of mainland and business scope. If we talk about mainland, so there is, when we doing business in mainland, so we have to do business in UAE only and work with government entity, not other than that. This is the specific area in mainland. We can trade in UAE and work with government entities. So, and just a second, office requirement. If we talk about office requirement, so you have to take a physical office over there and or a flexi desk registered with Izari. You have to take physical office or flexi desk. So there is no option regarding the virtual office. In mainland, department is this, Dubai Department of Economy and Tourism, and business scope is specific. And we talk about office requirement, you have to take physical office or a flexi desk in mainland. If we talk about freehold, freeland, so the department is so many department like DMCC, IFZA, yeah, DABZA, DSO. So it is depends on what you are doing. The object of the company, it is a startup, it is a consultant, it is a import export traders, and technology business, and e-commerce firms is also doing business in freehold business. Free zone. So, if we talk about the key advantage of free zone, it is the 100% foreign ownership. Like, if we want to do business in free zone in Dubai, so we have to do business in individual basis or a partnership basis or in company basis. We can do. We cannot merge with the Dubai citizens. We don't require to merge with the Dubai citizen. So we can do business individually. 100% foreign ownership. And one more thing is that 0% corporate tax. It is most beneficial for the free zone area working. And one more thing is that 100% repatriation. Whatever you earn in Dubai, so you can to take 100% repatriate in India if you want. So there is no tax in Dubai. If we talk about only Dubai, I'm not talking about the Indian taxation. I'm talking about only in Dubai taxation. So there is zero corporate tax. But in some object there is 0%. In some object it is up to 100% corporate tax. But in much more things you can do business in 0% corporate taxation. So if we are doing business in Dubai, so you can take advantage from these points we can take. And the another thing is that in free zone area we can do international business, and we can do on the basis of virtual office. We can do with the physical office or flexi desk also in free zone, only. So it is beneficial for the startups, consultant, import export traders, and e-commerce firms. We can take advantage from their free zone area. If we talk about the third jurisdiction, offshore business, so there is also so many authority, DABSA, REC, ICC, registered under specific offshore authorities and 100% foreign ownership. We can do business over there with 100% foreign ownership. Like us, we can do business with 100%. And the business scope is cannot do business inside UAE. This is the disadvantage of this offshore. If we do business in international, so we can do business in offshore. But if we do business in inside UAE, we cannot do business in jurisdiction offshore. Getting my point? Cannot do business inside UAE used for holding assets or international trade. This is only for the holding asset or international trade. If we want to do trade in UAE area, so we cannot do the jurisdiction in offshore. No physical office is required. No visa is required, and low setup cost, high privacy, high private startups. Like offshore business is good, but it is good in international trade. And this is beneficial for the holding companies, asset management, international business, and tax planning only. So there is a three jurisdiction. If we can discuss regarding the difference between in three jurisdictions, so there is mainland, free zone, and offshore. One thing is that regarding ownership, if we talk about ownership, up to 100% foreign ownership in mainland, and in free zone, we can do business 100% foreign ownership in free zone, and in offshore 100% foreign ownership. Getting my point? Business scope anywhere we can do business in specific area of mainland, and in free zone, inside free zone, and abroad, but excluding mainland. If we talk about the free zone area and business scope of this, so we can do inside free zone and abroad. That means an international business you can do, but you cannot do in mainland. It is the you can separate this part in free zone area, right? So if we talk about offshore, this is only for the international trade, like outside UAE only, sorry. Office needed, yes. In mainland, physical or flexi desk is needed in mainland. Free zone, it is depends on the working. Like if we talk about the working in mainland, free zone, and offshore, if we want to do business like restaurant, so we have to do within the area of UAE, so you can do in mainland, right? If we want to do trade but excluding mainland, so you can do business in free zone. If you want to do business internationally, not in UAE, so you have to choose offshore, right? There is so many option I have given you um, already, like restaurant businesses for mainland, trading business in UAE, excluding mainland is in for free zone. And if we talk about offshore, so you can do business internationally only. Tax benefit partial, that means activity based tax benefit you can take. And in free zone, if we talk about high sometimes and zero in many cases. Many cases you can take 0% taxation. So, free zone is good for business, for services purpose. You can do business in internationally. So you can opt free zone also if you want to elaborate your business, expand your business. So you can choose free zone area. If we talk about offshore, so high, obviously there is high taxation and 0% in most cases in zero, and some cases in high. Visa eligibility, obviously, if you set up a physical office over there in mainland and physical office in free zone, so you have to take a visa, because that's why you have to go there and set up your business in physical or a flexi desk basis or a virtual basis, whatever you want, in free zone and mainland. If we talk about offshore, so there is no specific business, there is no banking, there is no no banking, no physical office. So you can do only trade in international, so you cannot required to take visa in offshore cases, offshore jurisdiction. Ideally for local trade and services in mainland. If we talk about free zone, so you have to take startup business, international trade in free zone area. And in offshore, you can do asset holding, international business. You can do in offshore. Offshore. Okay. So if we focus on that particular jurisdiction, you have, as an Indian citizen, you have three options: mainland, free zone, offshore. So firstly, you have to decide what is your work, whether you are working as a you will work as a running shop or a restaurant or a trading business inside UAE or a services inside in UAE. So you have to choose mainland. And then in if we talk about free zone, so sorry, if you talk about the import export and trading and consultancy, so you can choose free zone. So you cannot require to set up a physical office. You can do virtual office also in free zone area. So free zone is good for the services and import export and startup consultancy, etc. Now we talk about offshore. Hold assets is good. Hold asset, manage international business, or create a tax efficient structure in offshore jurisdiction. So the this is the jurisdiction we have to decide whenever you want to incorporate a company in Dubai. So firstly, you have to decide your business, like what business you are doing and what business you will do in Dubai. So then you have to decide jurisdiction, and there is so many tax compliances, and there is setup, virtual office, physical office. Firstly, you have to decide like that. Firstly, you have to decide your object, and then you have to decide your jurisdiction, and then you have to decide the procedure how to incorporate a company in Dubai. So if we have to decide, we want to set up a company in Dubai, so what is the procedure is that: choose activity, select from DED free zone list, like mainland, free zone and offshore. Secondly, choose legal structure. What you want: LLC, like our company, private company or a public company. Then you have to decide LLC, and sole proprietorship, branch office, like offshore company, FZ CO, या फिर कोई ऐसा setup you want. And then you have to decide reserve name, what you want to take the name. Then you have to apply for the trade reservation, must comply with the UAE name convention, right? So This is the procedure. What we have to start your procedure. Choose activity, legal structure, and reserve your company name or a proprietorship name or a branch office name, whatever you want. You have to decide in fourth point. Get initial approval. Submit shareholder passport, visa copies, business plan. If required, you have to submit. First, you have to take the date, and then you have to submit visa, passport, business plan, etc. Choose location, lease an office, and get Izari or a secure a flexi desk. Flexi desk is a sharing office, right? The flexi desk is a sharing office. But you want to take a physical office, a flexi desk, or a Izari, or you want to virtual office. Then you have to decide the location. In case of आपके mainland and mainland, offshore and free zone area, prepare legal documents like draft and notarize the memorandum of association and other resolution, other documents, and there is so many list. This is not a specific list. Memorandum of association and other resolution. No, there is so many lists. There is so many documents you have to submit to incorporate a company in Dubai. So you have to collect these documents and submit it in particular department, like which we have already discussed regarding the department, uh, department of UAE, department of legal structure, like so many department are there. So you have to decide this and submit the documents there. Go live phase and apply for the trade license. Apply for the trade license. Firstly, you have to take name and submit all the documents regarding NOC, MOA, AOA, and other documents also. And then submit all the documents for the trade license, which you have already decided the license is depends on that. Like you want to do a food business like restaurant, so you have to take food license and other license for that particular area, and apply for the visa in second stage. If you are doing business in offshore, so you cannot apply for visa. This is skip. You can skip this process in offshore jurisdiction. Register with immigration, get your establishment card, and you can apply for the visa and other documents also. Open bank account. You have to go there and open bank account, and company documents to the corporate bank. You have to submit all the documents for the opening of bank account, and take VAT and other registration also. It is depends on what you are doing and what you want to do there. It is only depends on that. If we talk about the timeline and cost, approximately in mainland, the timeline is around 1 to 2 weeks and around 3 weeks, and the costing is this. Free zone setup, 3 to 10 days, and around 20 or 15 days, not more than that. And costing is almost same and little bit change according to the situation, and according to the jurisdiction, according to the working profile, whatever the costing is different in every cases. Summary checklist. First, we have to select jurisdiction, right? Choose activity and legal form, reserve name and get initial approval, prepare memorandum and lease office, get trade license, apply for visa, open bank account, and register for VAT if applicable. We can create a custom incorporation plan, including a cost estimate and required documents based on your specific business need. So this is the summarized checklist. You have to take decision regarding it. Then you can do the business there. Now, if you want to ask anything, you can ask. This is only the procedure and only the work in incorporation. So we have already discussed regarding it.
So the first question is, ma'am, can a unit in free zone import from India and sell in the mainland of UAE?
Ma'am, just a second.
Okay.
Yes, ma'am. Yes, ma'am.
Shall I repeat the question, ma'am?
Yes, ma'am. Yes.
So the question is, can a unit in free zone import from India and sell in the mainland of UAE?
Yes, you can do. But
Okay.
in another way out. So you are doing business in India and India is doing business in mainland. This is the different thing from free zone. This is different.
Okay. So the next question is, ma'am, can a person have business in mainland and also in free zone offshore?
Yes, you can do. In both area, in three jurisdiction, you can do anywhere. If you want to choose three jurisdiction, you can do your business. But in specific uh, means application. And you can do a single business in three jurisdiction, you can do business.
Shall we move to the next question, ma'am?
Yes, yes.
Okay. So the minimum compliance list once company incorporated, question mark, just like any returns, frequency of returns, etc.
Where is the question, ma'am? I want to read out.
Lenovo, a minimum compliance list once company
Minimum,
incorporated.
okay. Minimum compliance list once company incorporated, just like any return, frequency of returns. Yes, you have to file returns, annual returns and tax returns. Everything you have to file as per the Dubai compliances. You have to file. So if you want to take the list, I will provide.
So shall we move to the next question, ma'am?
Yes, yes, yes.
Can a unit in free zone import from India and export the same to USA or any other country?
Yes. But because free zone is also for the international work, so you can do the business in free zone for the international, like import, export, and the same to the USA and other countries. Yes, you can do business. Whether your services, trading business, or anything else, you can do.
Okay. So the participants, do you have any more questions? So please write in the chat box so that I can ask the ma'am.
Yes, I will share. I will share. This is not ready right now. I will share after some time. I will share.
Okay, so the next question is, what is the
Sorry,
investment limits?
another person asking regarding the what is the investment limits as per FEMA guidelines. So I right now I cannot share the investment limit. Actually, I'm only talking about the Dubai Incorporation. So this is the separate list and separate point from this. And if you want to take this question answer, so I will share another in another class, or you can take personally. You can message me on my personal number. I will share. Thank you.
Prinka, any other query?
I don't think so, sir.
टॉपिक कंप्लीट हो गया क्या भारती?
जी।
Okay, we have ample time. So we
I know.
participant are requested if you have any query relating to this incorporation of company in Dubai, you can ask or discuss.
And you can take my number if you want to take, if you want to ask any other question regarding this. And after this class, you can ask me anytime. Not for this particular time. You can ask
Mhm.
anytime. No issue.
One thing I assure कि Bharti is really helpful for any replying any query relating to company jack. Please share your number, ma'am. मैम
Okay.
पीपीटी में है क्या इसके प्रेजेंटेशन में आपका नंबर?
नो
So you
सर
can
मैंने
you
ऐड
can
नहीं
you
कर
can
पाई,
do
मैं
one
भूल
thing.
गई
You
थी.
can write in the chat box.
Yes, I have shared.
So ma'am has shared the number. If anybody have any questions, you can ask the ma'am directly.
Directly.
If
No
you
issue
have
any time, not for the particular time, and you can ask any time. I will definitely share the answer.
One more option is there. If you have not doubt relating to this topic, you can ask doubt with regard to annual compliances quickly so that we have 5-10 minutes discussion on this. Because today's topic completed well before in time.
I
So,
know, sir.
no problem.
Can you highlight about offshore company once again, ma'am? Actually, offshore business is regarding only for the international trading. So, if you want to do international work, not in UAE, so you can do over there offshore. And anything else, if you want to do business in UAE, so you can choose mainland or free zone. So, offshore is specially for the international work. You cannot do the particular area of UAE. So, this is offshore. So no required to take physical office, flexi disk. If you're talking about, you don't require to do that. Getting my point? Please explain. Thanks for the detail.
Thank you, Brijesh ji. And
ma'am,
one
we
more
have
question.
one question, ma'am.
Can we provide consultancy services in Dubai, sitting here in India? Yes, you can. In free zone, you can set up a virtual office in free zone area in Dubai, and you can do consultancy in India. You first you have to apply for the visa for the bank account opening and other formalities also, and you can do business in India, but you have to go one time in Dubai. You have to go for the completion of the formalities, then you can do business.
Thank you, Mr.
So
Thank
Any
you.
other query by I don't think कि query ना हो ऐसा but
Please
जब
ask some queries.
हाँ
I
but
want to
at a
answer.
time when we are asking suddenly got blank कि क्या पूछना था. We have opportunity to ask query with the practicing company secretary Bharti Goel ji. So if you have any query, this is the good. Any minimum capital requirement.
In if firstly you have to choose the particular work, and then you can check the minimum capital requirement.
What are the forms to be filled?
This is the different procedure. This is not a specific forms like A, B, C, like this is not the specific format and forms name. And you have to do the full procedure for the incorporation.
Hmm. VAT rate of
VAT
tax.
rate is also VAT rate is also depends on the working. This is not a
Hmm.
specific like
Okay. Is there
percentage,
any
and
website to
this
read
is
out the rules, regulations for formation with regard to the Dubai Incorporation? You have any?
okay.
We have
I will
any?
share. I will share.
है ना?
I will
So
share.
please
Okay.
share it with the presentation you have already shared. Website link you share
Yes, I have. I have
so
shared.
that कोई बनाना चाहेगा तो that can be easy for them.
Sure. Sure, sir. I will share the link, and I have already shared the presentation.
Hmm. Hmm.
Do we need to hire any consultant? Yes, you have to hire an agent to incorporate a company in Dubai. So you have to do the particular procedure. You have to follow this particular procedure for the incorporation.
Firm
Firm constitution.
provisions
And
like partnership company LLB. Which type of
yes,
constitution would it be?
you can choose any type. Partnership is also you can choose a company or LLC. You can choose, but the different name like LLC. But you have to do business in partnership, company or LLP. You can do. Is GST income tax is payable in India for services provided in Dubai? Obviously, you have to follow all the compliances which you have foreign working. You have to give GST, income tax, everything. You have to follow, in fact, all the compliances in India. If you are doing business in Dubai also, you have to follow all the compliances in India, and you have to follow all the compliances in Dubai. Any other question?
No. Makes sense.
So thank you everyone. If we are doing a business in of manufacturing from a Dubai incorporated company, what is the corporate tax rate, ma'am? Manufacturing. I'll check and then answer. So this there is so many lists. We have to check, then I'll answer.
Two more query
Is
आ
there
गए.
any exemption GST as export of services? These kind of questions, I'll share the link, and then you can choose the particular point like real estate business, consultancy, manufacturing, which you are talking about. So you have to check in that particular link also. That actually I'm not remember right now. So I'll share the link. For Indian company incorporation, we need CSCA. As similarly for the company incorporation, company in Dubai, is there any professional requirement? So you have to hire a agent. So already agent is also a professional. So you have to submit all the documents, and then they decide which department you have to submit particular documents. Then they incorporate a company. Entity certificate they are demanding. Yes, entity certificate they are demanding because the particular area in which you want to do business, the particular department decided which you have to take the particular certificate, like uh, food license, trade license. So they can decide, they can provide a particular format and certificate regarding this.
Entity certificate they are demanding. Entity certificate.
Actually, this is also depends on the working. So entity certificate is also demanding on the particular situation and particular work.
Okay.
It's of Dubai. We need to provide, or of India. You have to provide in Dubai.
So let us complete today's session.
Yes, sure, sir.
We have a wonderful session as discussed. We have covered 2 sessions in today's profile. Before
Thank you so much.
concluding formal vote of thanks, I would like to request to please attend tomorrow one more important session on business valuations, how business combinations take place, valuation of intangible, purchase price allocation, guide to become IBBI business registered valuer बनने के लिए क्या करना है अपने को, तो on these topics eminent expert CA Sweta Singh, registered IBBI RV, so she will take the session. Now I request Priyanka to take up formal.
Thank you so much, ma'am, for this insightful session. On
Thank
behalf
you,
of
Priyanka.
On behalf of all the participants, I would like to express our gratitude for sharing your expertise in the topic. We also like to
Thank you.
thank all the participants for joining us today and making this session so interactive. We look forward to your presence in tomorrow's session also. Have a great day ahead. Thank you.
Thank you so much, sir.
Thank you.